It's Thursday afternoon, March 9th, 2023, and you run a small company in San Francisco with 31 employees. Payroll is due this Friday. You have $1.4 million sitting in your business account at Silicon Valley Bank. That's the money you raised to get the business off the ground and have been carefully managing for 18 months when your phone buzzes with a message from someone you trust, telling you to move your money out of SVB. Now, not tomorrow, now. You open your banking app and start a wire transfer, but the system is slow, so you try again, and the page won't load. You call the bank and sit on hold for 40 minutes before trying again, and this time, part of the transfer goes through, but not all of it. The rest is still sitting there, and now you're not sure you'll be able to get it out in time. That night, you don't sleep because you might have been too slow. Friday morning, you wake up to a notification that the FDIC has taken control of Silicon Valley Bank. It's now the second largest bank failure in American history. That $1.4 million, the money you were responsible for, is frozen. 31 people are expecting to be paid. In 4 hours, their paychecks are supposed to go out, and there's nothing you can do. This is not a movie. This happened to real people, and the reason it happened, the mechanism underneath it, has been built into the system from the beginning and is still operating right now inside every bank you've ever used. Once you understand this, the rest of what happens makes a lot more sense. Most people believe their money is simply sitting in a bank, safe and waiting, protected by thick vaults and government insurance. We imagine the system was fixed after the Great Depression, and nothing fundamental has changed since. But that belief is the result of careful messaging, not fact. The truth is, when you deposit money into a bank, you're not storing it. You're lending it to a private company. In return, the bank promises to give it back when you ask for it. Until then, the money itself becomes part of the bank's pool, where it can be lent out, invested, or lost. It's not gone. But getting it back isn't up to you anymore. From that moment forward, you are a creditor, and creditors wait in line because the bank keeps only a fraction of deposits in reserve while the rest is put to work, circulating through loans, investments, and bonds, expanding far beyond the original deposit. Most of the time, you never think about that because nothing in your day-to-day experience forces you to question it. Everything appears to work exactly as expected until the moment that assumption breaks. The entire system depends on one condition, that most people aren't trying to move their money at the same time. If that just clicked, subscribe. We take what's happening into the lab and break it down. On any ordinary day, that condition holds, but the structure itself contains a flaw, because your deposit, which you can pull out today, is being used to fund a 30-year mortgage that won't be repaid for decades. That gap between what the bank owes you immediately and what it can actually access right now is the crack that everything falls through when enough people show up at once. This is not new. In October of 1930, a grain farmer in Nebraska named Harold drove into town to withdraw $80 for supplies. He had $4,200 in his bank, representing a year of labor and his family's survival, only to find the doors locked and a sign reading "closed until further notice." No matter how many times he knocked, or how clearly he could see the vault inside, he would never touch that money again. Not because it was stolen, but because too many people had asked for access at the same time, and the system could not meet that demand. Between 1930 and 1933, 9,000 American banks failed this way. The government responded by creating the FDIC to guarantee deposits and remove the incentive to panic, which worked for decades until something changed. Not the structure of banking, but the speed of everything around it. Back to March of 2023. Silicon Valley Bank failed because of a chain of ordinary events that moved faster than anyone could respond to. It started during the pandemic, when deposits surged and the bank invested heavily in long-term government bonds, safe and stable instruments that looked completely responsible at the time. Then interest rates rose. The Federal Reserve raised rates 11 times in 2 years, the fastest increase in decades, and those bonds quietly lost value in the background. But as long as the bank didn't have to sell them, nothing broke. And none of that shows up where people are looking because their balance still appears normal, their account still works, and nothing on their side of the screen suggests anything has changed. But then the moment arrived when deposits began to leave, not from panic, but from ordinary need, as businesses withdrew cash for payroll and expenses. That forced the bank to sell those bonds at a loss and announce an emergency sale of investments to raise cash. The bank described it as manageable, but the people reading it heard something else. Before most people had time to process it, a few well-known voices in the startup world began telling companies to move their money. The question became, are we already too late? By Thursday morning, it wasn't just a question anymore. People were already pulling money out. That day, customers attempted to withdraw $42 billion. Systems slowed, transfers failed, and those failures started to look like the bank might not be able to keep up. By Friday morning, regulators shut the bank down, completing a collapse that moved from announcement to closure in roughly 40 hours. Most people didn't realize what was happening until it was nearly over. The money itself did not disappear, it still existed, but access to it was gone, temporarily. That distinction between money that exists and money that can be used is what turns a financial event into a personal crisis. Employees were waiting on deposits that did not arrive, accounts showed balances that could not be used, and what looked like a functioning system from the outside was failing at the exact moment it was needed most. Not permanently, but long enough to matter. Long enough for rent due Friday to become a problem, for a card to be declined, for a transfer to stall, and for something simple to stop working at exactly the wrong time. The government guarantees deposits up to $250,000. That is the law. But anything above that number is not automatically protected. Most of the businesses caught in this collapse were well above that line, and what separated the ones that got through it from the ones that didn't wasn't better information or moving faster. It was whether they already had more than one way to reach their money, such as another account they could use immediately. When one avenue closed, the people with a second one were inconvenienced. The people without one were in crisis. The machine has not changed, only the speed at which it operates. At some point, someone is going to open their banking app on an ordinary day, try to move money for something that matters, watch the request stall, try again, refresh, wait, and slowly realize that whatever they were about to pay is not getting paid today. In that moment, nothing about banking theory, regulation, or insurance limits will matter. What matters is that they can't get to their money when they need it, and the delay is enough to cause real problems. Most people don't think about this until something goes wrong, and by then, it's harder to deal with. The first thing is knowing how much you have in one place. If that number is above what's insured, part of it isn't covered the same way. The second is simpler than people expect, which is having more than one place your money can live. That way, if one path slows down, you already have another one that works. The people who didn't feel that pressure in those 40 hours weren't making fancy moves in the moment. They just weren't relying on a single point to begin with. And the third is recognizing how this starts before it looks like a problem. It won't look like a crisis, it'll look like something easy to ignore. A headline that sounds technical, transfers that feel a little slower than usual, a system that isn't quite behaving the way it normally does. By the time it feels urgent, you're most likely out of options. Once you're in the situation, understand the money isn't gone, it's just behind a few more hoops now. Payments don't always move when you need them to. Transfers take longer than they should. Limits show up that you've never had to think about before. So you adjust. Start timing what gets paid and what can wait. Move money in smaller amounts instead of all at once. Call to move the due date if a payment might be delayed because of new restrictions. The first sign is never obvious. So, what's an early signal you'd take seriously? Drop it in the comments.